where traders from around the world will get to meet some of the senior executives of the industry and have some actual insights right from within the actual brokerage industry itself. So we're going to talk about a various range of very interesting subjects. So I'd like to welcome you all to this particular online conference. And to start off, without any further ado, I'd like to introduce you to Ilan Asbel. So I'm delighted to introduce Ilan. Ilan has been involved in financial markets for over 20 years, both in the capacity of a trader, so there's certainly something that you will all relate to there, and is now the head of a global group of companies involved in financial market analytics and research. He's very highly respected by his peers as a thought leader and innovator. So over to you, Ilan.
Can you hear me now? Can you see my screen?
Yes.
Andrew, you can see my screen? Okay, great. Hi, everyone. Andrew, thank you very much for that very kind introduction. So all the speakers in today's event will mostly be speaking about, I think, a lot of current market conditions. And so I decided, really as the keynote speaker, to kind of stay away from COVID and market volatility, which will be covered, I'm sure, in a lot of depth by all the other speakers. So instead, I'm going to speak about something else. I'm going to speak about you as a trader, right? And how your brain works when it comes to trading behavior. So before I continue, I'd like to thank a small company called Delcos Research for helping me put together the stats that I'm using in this presentation today. So we did quite a large research project. The thing we wanted to understand in our research is what are the trading characteristics or market events that affect a trader's ongoing participation in trading, right? That is, when a trader exhibits certain behaviors, right? What does it mean for that trader's long-term participation in the markets? How is the trader affected by market events and adverse trading conditions, right? So you'll find in the industry that so-called trading experts are always talking about trading psychology, giving you tips of what to do or not to do. They do this based on hearsay, possibly some limited personal experience. But what we decided to do is to get some real data and number crunch it all. And it was quite a lot of data that we number crunched. It was an extensive piece of research. We analyzed approximately 3 million transactions performed by about 12,000 traders over a period of 7 years. I'm guessing it's probably one of the most extensive pieces of market psychology research done in the currency markets to date. So let me share with you some of the findings, and hopefully you can learn something a bit about how your brain works and what you're affected by on the markets. So there's 5 major events that seem to affect your long-term participation in the markets. Right? The first one, interestingly enough, is incurring an excessive amount of consecutive losing trades, right? So if you, in fact, the magic number is 7. It seems that if people incur more than 7 consecutive losing trades, it results in a 28% reduction in your trading in the long term, right? So definitely some psychological effect over there. The next one takes a little bit of explanation. We call it inconsistent position sizing. And what that means that you're trading the same lot sizes across instruments where the dollar exposure is different. So for example, you're trading 1 lot of euro and 1 lot of Dow. Both are 1 lot, but actually the movements result in different profits or losses, right? And we see this type of problem really happening if traders use EAs or robots, where the traders just set 1 position size and the robot goes and trades a whole variety of instruments. And this type of inconsistent position sizing, we have found, results in an even bigger effect, right? 42% less market participation in the long run if you're using inconsistent position sizing. The next one's quite interesting. If you're the kind of trader to hold hold losing position for an extended period of time, you're not alone. Okay, on average, losing trades are held twice as long as profitable trades. But even worse, it seems that if you're a trader that does this, you're likely to only trade half as much in the future as traders that don't hold losing positions. Right, so if you're holding losing positions, you seem to as soon as you kind of get out of them, you take a breather and you slow down your trading participation. Now, the next one is probably no surprise to anyone. It's regarding economic events. So many traders are really adversely affected by economic events such as non-farm payroll, interest rate decisions, and the like. Right? This adverse effect is mostly due to two factors. Some traders are simply unaware of the news events that are happening, right? Or they just don't understand the impact that news events have on market volatility, right? And this is the big shocking part, is that if you've been adversely affected by an economic news event, you're likely to decrease your trading participation in the market by 68%. That means you're trading almost 1/3 of what you were trading before you were adversely affected, right? Again, a kind of shock to the system, right? You're trading, suddenly non-farm payroll comes out, the market moves wildly, goes against you maybe, you're taking a step back, right? Very interesting. And finally, the fifth most influential event that can happen to you that will stop you from trading is incurring an exceptionally large loss. Okay, this decreases your long-term participation by over 84%. Right, in the market, you're trading 1/5 of the amount that you traded before you incurred that large loss, and you can understand it, right? You're trading, suddenly you lose a whole bunch of money. Then the next day you wake up and you think, okay, is this game really for me? Do I want to be involved in this? Right? Okay, so it's one thing, the experts have told us. Here we actually number crunched the big stimuli that make you stop trading. But how do we actually prevent ourselves from having these behavior changing events, right? So firstly, you need to continuously reassess your trading strategy, right? If you're incurring excessive amounts of losing trades, change something, right? It's not going to fix itself. Don't put a blinkers over your eyes. Your strategy is just not going to fix itself, right? So do something about it. Second, if you're trading different asset classes or using an EA or robot to trade, calculate your volumes carefully before you trade, right? So ensure that you're not underexposed or overexposed on any individual instrument, right? Especially if you're trading across multiple asset classes. Third, don't be scared to incur losses, right? Losing trades, they take up valuable margin and stop you from sleeping, right? Even worse, close them early and move on with your life. There's always new opportunities to take in the markets. Fourth, very important, keep your economic calendar open. Be aware of the events that could impact your trades and adjust your stop loss levels during your trades to compensate for increased volatility, right? If you open your trade and you set a stop loss, but now non-farm payroll is coming up, don't just sit with the same stop loss, increase your stop losses, right? Increase the size or decrease your position or something to make sure you manage your risk correctly, right? And lastly, always set a stop loss, right? And it's very important that you work out your stop loss not only in pips, but also in dollar value, right? You'll find that a lot of the time you underestimate your possible risk when you simply look at how many pips you may lose. So obviously I'm quite limited in terms of time. It was a very quick keynote speech that Andrew so kindly asked me to give to you today. And I want to kind of conclude with a quote I found from infamous Viktor Frankl, right, which I thought was very, very appropriate for this talk. Between stimulus and response, there is a space. In that space is our power to choose our response. In our response lies our growth and our freedom, right? So I hope that after this quick presentation, you'll take some proactive steps to prevent yourself from experiencing these negative stimuli, right? But if you do experience them, choose your response rationally and not emotionally. Thank you, Andrew, for the opportunity.
Great pleasure, Ilan. And now, further to that, was very interesting indeed, and I hope that was very useful to most traders. Certainly, definitely a lot of information that you can certainly relate to there. So now, in terms of looking at the markets and so forth, I'm going to hand you over to Ken Agostino, who is CEO at Rose Capital Management and has a great deal of experience in this particular industry, and talk to you about some interesting analytical aspects of the market. So over to you, Ken.
Andrew, thank you very much, and good evening, everyone. Thank you so much for joining us here today. I'm sure if this were an actual in-person event, I'd have to pause right now for the significant applause as I walked across the stage. So for anyone doing that at home right now remotely, thank you very much. I appreciate that. My name is Ken Agostino. I had been the CTA at Rose Capital Management for a number of years, as Andrew alluded to. And for the last 6 years, I've been on the risk management team at FXDD. The last 20 years I've spent in the EFX space, really starting on the online trading space since its infancy. And prior to that, I had been in the foreign exchange banks and hedge funds, working mainly as a spot forex trader. So I've been in the industry for a long time. The subject matter I'd like to cover today is the market environment directly affecting traders, right? Everybody trading forex from a standpoint of where we've come from, where we are, and what that means in the very near term. So let's begin. Can everyone see my screen?
Yes, absolutely.
Okay, so where we were, where we are, and again, where are we going, what it means for forex traders going forward. As the calendar year flipped from in 2020 off of 2019, I don't think anybody in the FX community was sorry to see 2019 go away. We had gone through a period of just excessive lacking in volatility, really unprecedented low volatility. If everyone can look at the chart that I have up there, this is the JP Morgan FX Volatility Index going back to 1993. So this is a pretty significant kind of 7-year look at exactly what volatility was in 2019. That little blue line I have there, you can see where 2019 was, and it's not even close to the median. So we were really in unprecedented times. To drill down a little more into this, what I've got here is about a 6-year euro chart. The euro dollar by far is the most actively traded and popular pair for all traders around the world, but particularly those in the online community. So let's look at a 15-month period that you can see I have bracketed there from October in 2018 to the end of 2019. So like I said, 15 months, and the euro dollar, we saw a range of 109 to 115. So basically 6 big figures. So let's put that in context. The black arrows that you see are approximately another 15-month period from late 2016 up until very early in 2018. And in that time period, the euro dollar had a range of 104 to 125. So 21 big figures, and basically 3.5 times what we saw again in that really tight bracketed 2019. The volatility in currency markets are deep in volume, as we all know. They're very sophisticated markets in technology that allows traders access and helps to keep these markets efficient. Why the markets become so lacking in volatility that traders crave is really unimportant. We certainly needed a catalyst, and we got one recently in a manner that no one could have imagined. Really, who could have predicted that a virus that would change the lives of everyone on the planet would be the catalyst that FX markets needed? And I use that word needed. We absolutely needed something to kind of shake things up. Trading FX, like anything else, is difficult. It's not easy. In order to be successful, you need capital, you need patience, you need a certain skill set to know exactly when to enter and exit positions. Which currency pairs should you be trading? You know, every pair is not perfect for every person. Each of them have their own individual personalities. But with all that, what we need is movement and volatility. This provides a platform necessary for all these trades. Typically in a normal year, these sort of catalysts and events that create volatility will come in things that we're more used to, political changes. We have an election year here in the US, and I certainly think leading up to, during, and probably soon thereafter, that'll be another catalyst for us, a more expected catalyst that we're used to. Various economic swings with the data changes that come out on a daily and weekly basis. Interest rate changes, not only here in the States, but around the world has that effect, as well as geopolitical news. Those are the things we're much more accustomed to, creating the volatility that we really look for. So to kind of give you a little snapshot of how this volatility has changed and really improved is the word I would use. Again, we talked about 2020 when we came into it, how dismal 2019 was. This is a very short-term chart of the euro dollar, really just starting in mid-February when the chaos really started to take place. We rallied in the euro from 107 to 115. So right there is 8 big figures. So right there we eclipsed, you know, the 15 months of all of 2019 that we talked about. It sold off down to 106, so another 9 big figure move, rallied to 112, another 6 big figures, and, you know, since then has oscillated, you know, much more in a stable fashion, but I think you get the picture. And this type of activity was happening through all currency pairs throughout that whole time period. It wasn't just limited to the majors. Now, a lot of FX traders love this, and I do, and it might be a little over the top for a long-term basis, but it's not sustainable. There's no question about it. But what it does do, what these types of catalysts do is this activity has an impact on the momentum that we kind of crave for an extended period going forward. You know, one of the great appeals of trading FX is the ability to access the same market the largest players in the world do. Banks, hedge funds, they access the same markets that you do. If you're online trading, wherever that may be, however much is in your account, you know, the largest player in the world have edges in different ways, but you're all accessing the same market. In the late 90s, day trading became a real catchphrase, and it was definitely an equity terminology that was bandied about kind of as the Dow was breaking 10,000 and, you know, people were excited to day trade stocks and whatnot. But really, I would argue that what is a better platform than Forex for day trading? I don't think there is any. In this new normal environment that we're in, and forever how long we'll be in it, and there might be some people who stay in it, working from home, you know, having it become more comfortable and really a seamless task. Having a trading account really seems like the perfect fit that I think. Given the FX market is able to be accessed, researched, and is appealing from an opportunistic standpoint, I don't think there's a better time to focus on a Forex trading account. Is this a new trend? Is this something that just came about with this kind of volatility spike and people going home? No, not really. But it may just be that we're more focused on it now given these circumstances. From a standpoint as measured by the amount of retail traders that are already involved in this, that have been trading Forex, I think it's a growing trend that should continue to escalate. This is just a map that I think is old. I think it's more than a couple of years old, but it just kind of gives you a little bit of a visual scope of just exactly how many participants there are, how global it is, how widespread it is that, you know, people are accessing Forex markets today like never before. And I think this is a trend that's only going to continue. Now, again, as we talked about, the volatility spike that we recently saw at the beginning of this chaos is not something that we can possibly expect to maintain and persist. But there are a number of factors that will contribute to revisiting kind of normal, even heightened volatility levels. One of those is economic data. You know, we see these numbers come out multiple times a week, you know, for all of the major countries. We focus on them, but maybe given the crisis, we can expect much wider ranges of what the expectations of these numbers will be. I think it'll be much more difficult for economists and the experts to predict certain things, given, they're dealing with facts and figures never having dealt with before. So, typically you'll go through your economic calendar and you'll see GDP today at 8:30, retail sales, housing data, unemployment figures, etc. All of those data. And I think there'll be a new nuance to those. I think there'll be something that, again, will help to create and extend the volatility. Commodities and stocks. Everybody's aware of all the markets, but I think more so now in this environment, everything is starting to be tied together, and everything touches currencies, if not an individual currency. If you're paying any attention at all to what's gone on in the financial space the past week or so, you know what's happening with oil. Oil is traded at levels we have not seen in over 2 decades. This has had a really enormous impact in what we call the commodity pairs, the Canadian dollar, Australian dollar, and the New Zealand dollar. Typically within the G7 space, these have been the more less volatile pairs. But now in this new environment, really that's all changed. And it's not only oil, but the price, the expected demand or lack thereof, the over and under supply of natural resources will make these pairs much more attractive to trade. Obviously, the stock market is something everybody's aware of. You are much more attuned to it on a daily basis. And it always does have an impact on the FX markets, but I think more so today than ever before. And it's really difficult to imagine that any time in the near future, that volatility is going to slow down. So what does this really mean for all of us? And again, this is for you at home remotely. If you are trading Forex, what does this mean for you guys? Well, there are more pairs and crosses trading, moving and volatile each day. Again, we talked about currencies like the New Zealand dollar and the Australian dollar, and they're unique because of their value versus the US dollar. They require less margin to trade. But, if you make 1 point on one lot in Aussie and Kiwi, you return the same value as you would if it were euro and sterling. So I think these are new products that I think people will start to look at a little more. What could traders do now? What should they be doing? I know Alon touched on some very important things that I think traders should be focused on, or what they need to focus more on, but certainly be aware of when news is coming out. Especially in this environment, there's new news that we have to be aware of. Obviously, there's always a scheduled list of things that you can count on, but I think there's a new kind of normal of unscheduled things that we never would have cared about, such as medical testing and whatnot, and figures of, people recovering or not recovering, economies opening, not opening. And I know Alon touched on it, but I'll certainly add to it as well. Trade with stop losses. I don't hold myself out as a trading coach by any stretch, but if there's a few things that I would tell any traders, new, young, old, anything, you need to trade with stop losses, and do so when you enter into a trade. That's when your idea is most fresh about what you can expect from an open position, what you hope to happen, but what you also understand may happen negatively. And it happens all the time. You're not going to have all winners. So really protect yourself by trading with stops. This will allow you to think clearly, especially when you have an open position, so you don't have that fear of, a more significant loss, whether it be a market gapping away, unexpected news, or really allow you to look for the next opportunity while you have an open exposure. And like I said, you have protection in place. And I think the biggest thing is something that I try to do now is take advantage of the momentum that volatility produces. I've got a 60-minute dollar Canada chart up here. Nothing fancy, as you can tell. I rarely use indicators, occasionally some moving averages. It's just not something I like to do. I like to look at price action. It's the most simplest, basic, and I think the most valuable tool. Where has a currency pair struggled? Where has it ran into a lot of buyers, a lot of sellers? This you can use to your advantage. I've, made a couple of trend lines here, a little support channel. The arrows indicate where, in this case, dollar Canada couldn't go through, and then when it did, that was an opportunity. I will often start my week on a Sunday night, bringing up charts working from the longer term back out, weeklies, dailies, and bring it in and look for kind of inflection points, keys where the market had trouble staying at. That's really what's going to be, bring your attention to something that'll create opportunity. You don't want things that are just sitting in channels, not moving. Again, you could look at this 60-minute dollar Canada chart. It's very random, and you can see there's a number of pressure points here that would lead themselves to an opportunity. I'm not a trading coach. I've done this a long time, over 35 years. I've made every mistake in the world. And when younger traders ask me, or any trader, the one thing I always say is the why doesn't matter. Why did euro go down and sterling went up? Typically, someone said that because they will long euro. Why didn't dollar yen follow the stock market the same way up that it has been recently? And typically, they're on the wrong side of dollar yen. So I always like to say the why doesn't matter. Kind of focus on your plan as you're getting into a position. So here we are. It feels like in some way, many people are just now discovering the opportunity afforded by trading Forex remotely every day, all day, any time of day. As we go through this conference here, I'll let my colleagues talk more about what FXDD specifically has to offer. I've been involved in the EFX space, like I said, since its infancy. While I'm certainly partial right now to which clearing firm a client should consider, I encourage you to be very mindful of the following as it really relates to your broker. The first thing is spreads. I would not get too hung up on spreads unless there is an obvious or noticeable lag between what your current broker offers and what you know to be industry standard. Believe it or not, as many brokers as there are, most of them tap directly or indirectly into very same small liquidity pool, much smaller than you think. So a 10 to 2 is really not that big a deal, in my opinion, when you consider what you're trying to accomplish. Another thing I think that can help traders, especially again in this environment, is to diversify the currency pairs you trade. Pay more attention to what we'll call the G7 exotics. And is your broker competitive in those pairs? When I wrote this, I think I had taken a quick look at the euro, and over like the last couple of day period, it had been in a 70-point range. Sterling Aussie, as an example, was in a 200-point range. Now look, Sterling Aussie is something that we call a synthetic cross, meaning two G7 pairs that are deep in liquidity, and we just put them together. There's no great ties between the United Kingdom and Australia that would make this desirable for some reason, news specifically related to that. But it moves a lot. And as Alon talked about, as far as your the amount you're trading for each individual pair, you as the trader, you control that. So you can size up or down accordingly. Euro, dollar, and the other G7 pairs, they make the headlines, but you should only be interested in products that move, plain and simple. And you might find that you like a product that stays in a really tight range better. But you also might find that you like a product that, as we're talking about Sterling Aussie, has a much more significant range. So, look for those and don't worry about what they're saying on Bloomberg or CNBC. Look at your broker's overall offering. It's really broken down to a few things, right? Stocks, currencies, CFDs, commodities, metals specifically. These are the tradable products that every speculator should look at his or her toolbox to create what brought them to trading. You can't be in every product all the time. That's not going to happen. But over a longer period of time, if you look at different products, you'll find an opportunity in any one of these. The last thing I want to leave you with is over trading. Anyone trading is guilty of it. I've done it. You've done it. But I think it's something we just need to step back some time and be a little more cognizant of. Just because these markets are open every single day, 24 hours, they have the sign up that says, come on in, we're open, doesn't mean there's opportunity in those time periods. So, certainly be selective, have a plan, and stick to it. If you missed the train, if you saw a move coming and you get frustrated, you didn't get on that one, there's another one coming. So don't get too nervous about that. So thank you so much. I'll be here for some Q&A. I'll leave the rest to my colleagues here, and my contact information I'm sure will be made available. If anybody has any questions specific to trading, I'd be happy to respond to that. Certainly be safe, be healthy, and trade well. Thank you.
Thank you very much, Ken. That was a very interesting indeed. And now, basically, the next thing we'd like to do actually is to be able to introduce you to Ehan Menon, who is an analyst at FXDD, and he's actually really at the coalface there, in front of the traders, in front of the actual the live markets, and is working directly with the company and with its clients. So certainly, in terms of how to interact with FXDD and so forth, and how to interact with markets, Ehan is really an expert in that matter. So do stay with us also, because after that, we're going to talk about a specifically special offer that FXDD has which is exclusive to people who joined us for this particular conference today. So it's very beneficial for you as traders. So over to you, Ehan.
Hey guys, thank you for joining us today, and thank you for the introduction, Andrew. I'm Ehan. I'm a researcher and risk manager at FXDD. I work with Ken. I also happen to write What's Moving Markets. It's a fundamentals-based publication, the in-house publication of FXDD. You can find it on the website. We tend to focus on fundamental views and how those drive markets. We don't limit ourselves to any asset because we try to understand the big picture and everything that's going on. That being said, I think there's a really big transition going on right now, and that's really what I'm going to try to share with you today. So let's get right into it. Let me just share my screen with you. Let me see. There we go. Can everyone see that? Okay, great. So COVID-19 has had a massive impact on the global economy, as you're all aware. Every day we see new headlines and we find ourselves trying to make adjustments, especially if we're trying to trade these markets. While trading volatile markets is exciting, as Ken has talked about at length, I think that getting lost in the details will make you miss the big secular transition that's happening right in front of your eyes. Secular transitions by nature tend to happen slowly, so they kind of blindside us when we see their impacts and externalities all of a sudden. So today I'm going to focus on the mechanics of what's happening with the economy so we can make some good asset allocation decisions, make some good trading decisions. So what's the secular transition I'm talking about? It's actually an evolving conflict. It's one that's happening in the background of global currency markets. It's the battle for global reserve currency status. It's the battle where the dollar rules supreme, the euro is a shaky alternative, and the renminbi is a rising and ready challenger. We see symptoms of this from time to time. Sometimes we even see direct confrontations, like last year where we had the trade wars and prospective currency wars. In fact, even reserve status is part of a much bigger picture struggle of who's going to be the leading economic power of the 21st century. The two frontrunners are obviously the United States and China. We tend to focus on reserve currency status because it indicates the completion of the power cycle. The world's dominant empire is typically the one that issues the world's dominant currency. So what's COVID-19 got to do with all of this, right? Like any war, there are multiple fronts. And in this case, there are divergent pressures on the global currency system. Now, I'm going to talk about these pressures later, but let's just say that COVID-19 has sped up our timeline in this battle for this currency battle. It's not likely that any currency is going to win this battle in the near term, but we're moving into a transition era. During this transition era, we're going to have multiple competing currency systems, and this competition isn't going to be friendly. So we're likely to experience a lot of currency volatility going forward. So if you have a foreign business, or you're an investor, a global investor, or you actively trade currency markets already, this is going to impact you. So it becomes imperative that you equip yourself with the knowledge and best tools and liquidity in the business to be able to deal with these issues. Before we get into all of that, let me give you a brief overview of what we're going to discuss today. Over the next 15 minutes, I'm going to lay out the mechanics of a reserve currency. I'm going to talk about the existing pressures on the global economy and show how COVID-19 has forced us into a reserve currency transition. Then we look at the last transition and create a roadmap for the future. finally, we're going to look at the market implications of this transition. So, as I mentioned earlier, the dollar is the world's current reserve currency. But what does that really mean? Well, put simply, it's just the most dominant economic system. Whether it's giving a loan, getting a loan, making a payment, or investing your money, a reserve currency is the currency of choice for a majority of people across the globe. To give it a slightly more rigorous definition, a reserve currency is the most relatively attractive currency as measured by its functional capacity. Many of you are familiar with the functions of money, a means of exchange, a unit of account, a store of value. But what do these functions actually mean? Well, they mean different things to different people. They mean one set of things to investors or traders, and they mean another set of things to policymakers. Private institutions tend to look for cost efficiencies, and policymakers tend to look for stability. So when you're evaluating the relative attractiveness of a currency, it really matters who you are. Are you a lender or are you a borrower? Are you a policymaker, or do you have revenue streams or costs in a currency other than your own? The list goes on and on, obviously. So it's really hard to become a reserve currency because there's so many demands. As a result, the world's reserve currency is typically issued by the world's leading country. At this point, you're wondering, why does all of this even matter? Well, it matters because reserve currency status is actually changing hands today. We're moving from a dollar reserve currency world to a tripolar reserve currency world. There are going to be multiple competing reserve currencies: the dollar, the euro, and the renminbi. This has huge implications for exchange rates and for asset prices. For example, the last time we had one of these transitions, it was from the British pound to the US dollar. In the decade after World War II, the US stock market more than doubled, and the pound actually devalued 40% against the dollar. Those are absolutely huge moves, and if you had the foresight to be positioned from those, you could have saved yourself a lot of pain and actually reaped a lot of gain. So what's COVID-19 got to do with the race for reserve currency status? Well, to put it simply, it's accelerated the timeline. Prior to the outbreak, there were three big pressures on the global monetary system. I'm going to touch on these briefly, and then I'm going to talk about COVID's impact. The first problem is that monetary policy is no longer effective in stimulating economies, especially in the developed markets. Interest rates are at zero, which means there isn't any room to go lower. The second problem is that when monetary policy runs out, you usually turn to fiscal policy. But fiscal policy is really hard to agree on in developed economies, and debt levels are already extremely high. The third problem is that the world is extremely dependent on the US dollar, even though the US economy isn't as strong as it once was. So when you take a step back, what you really realize is this is a story about divergence. It's a divergence between the United States, Europe, and China. Or, as you can see in the slide, it's a divergence between emerging markets and developed markets. The euro is suffering the most. The dollar can manage because it's the world's reserve currency. And the renminbi is actually free of all these pressures. So what has COVID-19 done? It's come in and increased this divergence. The question is how? After all, people say that the flu kills more people. Well, that's true in healthy people. It's not entirely accurate to people with underlying conditions. In the United States, you can broadly categorize annual hospitalized deaths into two buckets. You have people with chronic conditions and you have incidental deaths. About 80% of hospitalized deaths in a year are due to chronic conditions, and the remaining 20% are due to things like microbial disease, crime, and accidents. 80% of expenditure also happens to be on chronic conditions, and the remaining 20% is on incidental deaths. So what's unique about COVID-19 is that it's jumped from the microbial bucket, which is really less than 10% of deaths a year, into the chronic disease bucket, which is a much, much bigger population. And we have a similar situation across the globe. As a result, we've basically had to stop all in-person activities, which is the first order consequence. But that's not the worst. It really gets complicated in the second order consequences, and that's particularly in the case of interest payments. Businesses around the world have low and lower top lines. As a result, they can't really meet their debt obligations. This causes shutdowns, foreclosures, and asset sales. And it triggers a self-reinforcing cycle. Incomes reduce, which makes you reduce your spending, which makes you sell assets, and makes you then further pull back your spending. Your spending is someone else's income. And the cycle continues and continues until the government usually gets involved. But like we said, the developed world has run out of monetary ammunition. Fiscal policy is really hard to agree on, and debt levels are really high. And the world is dependent on the US dollar in a world where the dollar might not be as stable as it once was. So we're trying to come up to solutions to really hard problems today. Namely, the problems are, how do you use monetary policy in a world where interest rates are at zero? How do you use fiscal policy when debt levels are high and nobody can really agree on how to use fiscal policy? How do you continue to hold dollars in a world where the US economy isn't as stable as it once was? Each one of these has considerable amounts of nuance. So I'm going to go through each one of them individually. Give me a second. So let's talk about monetary policy. Classically, monetary policy is done through the reduction of interest rates. But since the financial crisis, we're now in a world where monetary policy is pushing on a string. Pushing on a string means that monetary policy is now more capable of pulling a country into recession than it is capable of pushing it into expansion. This is because of three things. First, interest rates are already low. So going from 0.5% to 0% doesn't really mean much for business on the ground. Second, when you reduce interest rates at such a low level, it helps financial assets more than the real economy. So you actually just increase inequality. Third, going lower than zero is actually just taxing savers. So you can't actually reduce interest rates below zero because it distorts economic incentive structures. So COVID-19 has forced the United States to go to zero. And Europe and Japan have already been at zero for a while. So in order to overcome this, what have central banks done? They've gone out and printed money effectively and bought financial assets. To keep the value of these assets up, they buy these financial assets to prevent financial institutions from failing and from avoiding a financial meltdown and a meltdown of the system. But what does this do for the average worker? Not that much. So that's where fiscal policy is supposed to come in. But there are two problems with fiscal policy too. The problem is that it's easier to deploy in some places than others. And that's the first problem. It's readily available in places like China. It's easier to use in the United States, but it's almost impossible to deploy in Europe. The euro is actually a really interesting case because in Europe, you have a monetary union, but no fiscal union, and their responses are in line with that. This kind of misalignment within a currency creates huge mechanical issues. When you combine countries using a single currency, they all need to have similar risk characteristics, but lacking common fiscal policy, countries will develop different risk characteristics. Now, usually these risk characteristics are expressed in the form of exchange rates and interest rates. But lacking this because they're bound by the euro, they can't do that. It's kind of like trying to fit a square peg into a round hole. You can do it, but only after structurally damaging the peg. And that's exactly what's happening in Europe today. You're having structural damage to the economy. In the United States, fiscal tools are more readily available, but political polarity makes it really hard to use these in a timely fashion. Parties come together during times of stress like now, but otherwise there's constant gridlock. So that being said, these governments might come up with fiscal solutions to the current crisis, and they are. They're doing a great job. But that's really just kicking the can down the road. And that brings us to our second problem of fiscal policy. This is illustrated in the graph. When a government spends, it has to spend from some source. The government can spend its income, it can borrow, or if it manages its own currency, it can print money. In the United States, the government revenue isn't enough to finance its spending. So the Treasury borrows money from abroad and the central banks print. You can use printing to offset the burden of debt, but you're basically shortchanging your lenders and the international community. So if you continue down this path, you start losing credibility as a borrower and as an investment destination. And that causes capital flight and currency weakness. So as you can see, the pushing on a string problem is complex enough to begin with, but it gets even harder when you have limited fiscal capacity. Now, I'm not going to get into the details of the solutions, but let's suffice to say that the solutions to these problems will cause huge printing of money. You can already see that with the Fed and ECB assets in the chart below, right? You see with the response to the crisis, both central bank assets have spiked. As you can imagine, this is extremely inflationary. But wait a second. Almost any trader knows that inflation has been non-existent for almost a decade in developed economies. But I think that that's because most people miss that there are different kinds of inflation. You can have 4 different kinds of inflation. You can have energy inflation, you can have goods and services inflation, which is the inflation everyone focuses on. You can have risk asset inflation, so inflation of stocks and bonds, or you can have currency inflation. So the question before us today is, what kind of inflation are we going to engineer? We don't want energy inflation. We can't really generate goods and services inflation without massive amounts of fiscal stimulus continually. And risk asset inflation of stocks and bonds mainly favors the rich, so it just increases inequality. So what we're really left with as a solution is currency inflation, or in other words, currency devaluation. And that brings us to our third global pressure. The dollar remains the world's leading currency, but now it has more public debt, private debt, and unfunded liabilities than ever. The euro, the world's second biggest currency, has been a stagnant economy for almost a decade. Just as we discussed, the solution of both of these economies is to print a lot of money and pile up more debt. On the flip side, you have China, which continues to grow at a rapid pace. They're increasingly influential in global supply chains and have very large domestic savings and very little external debt. To add to that, China actually has room to stimulate using monetary policy, and their governance structure allows for fiscal policy to be used in a timely fashion. Yet the renminbi remains a small portion of the global financial system. So if you actually look at the chart, they're actually less than 5% of global FX reserves. So the question before us is how long can this system hold? The instability can't persist, and the dollar can't continue to finance its dominance simply through the printing of money, much like the euro. As you can see, there's an obvious imbalance emerging. Monetary and fiscal policy are going to cause huge amounts of money printing, both in the dollar and the euro. But this can remain status quo for a while. And this is because it's convenient, efficient, and safe to use dollars and euros. But how long is this going to remain safe, and how long is it going to be perceived as safe? We can actually gain insight from this by looking at the last big currency transition, from the British pound to the US dollar. In fact, studying the history has allowed us to come up with a stylized roadmap of sorts, and I'll share that with you. But first, let's look at the sequence of events which allowed the dollar to overtake the pound. Now, history doesn't repeat itself, but it does rhyme. So between 1890 and 1910, the United States was already the world's largest economy. But the world's leading currency was the British pound. But much like China today, the US dollar was a small share of global markets. The government of the United States had capital controls, which China has today. But more importantly, they didn't have a central bank to provide liquidity and stabilize markets. As a result, even though the United States was the biggest economy in the world, it was a small part of global markets. It actually depended on the British pound for trade, much like China today. China actually, most of its trade is settled in US dollars. In 1913, though, the United States set up the Federal Reserve, which created stability in US markets and allowed for the US banking system to spread globally. Then came 2 exogenous events. There was World War I and World War II, and they hurt the British Empire a lot more than the United States. Due to the economic damage, the British Empire wasn't able to maintain currency stability. They basically they didn't have the monetary firepower to be able to stabilize exchange rates and interest rates. So as a result, people all flocked to the dollar. By the end of the transition, the United States was a net lender to the world, much like China today, the largest country in trade, much like China today, and also the fastest growing economy, much like China today. So you can see how history sort of rhymes. So having studied the roadmap, here's our stylized roadmap. So having studied the history, here's our stylized roadmap to a reserve currency transition. So first, a rising country's trade typically grows until it dominates global trade. Seeing this, domestic financial institutions see an opportunity and start financing this trade and providing credit. These financial markets, these newly created financial markets, need to be stabilized by a central bank. So that's really essential for the stability of financial markets, having an organized central bank. Next, you'll see foreign companies begin to start settling trade in this foreign currency. Seeing this, other financial firms begin to borrow in the local currency because they see the stability of interest rates and also the stability of exchange rates, which is backed by a central bank. Finally, we get to the point where other central banks start buying this currency and start using it as currency reserves because they need it to maintain their own monetary policy and their own exchange rate stability. And now we get to the good part where a country finally gets to monopoly status, or what historians call an exorbitant privilege. This is the case with the United States dollar. So I think this is a good roadmap to think about the transition that we're currently undergoing. That being said, I don't think that any single currency is going to get to the final stage of monopoly, or at least in the foreseeable future. More likely, we're going to enter into a world where the US dollar and euro have less and less influence, and the Chinese renminbi has more influence. There are going to be a lot of hurdles to this, but we're eventually going to get to this place. And the journey is going to be extremely bumpy. We saw an example of this last year in the trade wars. This transition to a tripolar world can happen in one of two ways, depending how the countries handle it. You can either have a globally coordinated monetary system, or you can have competing reserve currency systems. It's more likely that we're going to have the second, and that's actually already what's happening. You just need to connect the big picture dots. We already have a race between nations for nuclear technology, 5G, AI, quantum computing, global retail, and energy self-sufficiency. And you also have trade and FX policy being weaponized by these countries. Even if the US assumes a more friendly foreign policy position after the election this year, and the EU somehow manages to put together a fiscal union, it's almost impossible that China is going to give up a century-long approach of century-long isolationist policy approach. So what we're looking at is three alternative, relatively stable currencies, all competing with each other, with all with their own pros and cons. Governments, traders, speculators, and investors, they're all going to be able to increasingly jump between these alternatives. So in our view, a tripolar world is one with more currency volatility. The best way to approach this is to look at your business, look at your investments, and look at your currency trades. And ask yourself, am I well positioned for this? Or am I at odds with it? Remember, at the end of the day, when you look at a long-term chart, the small short-term price spikes disappear. So what you really need to ask yourself is whether you're going with the tide or you're going against it. Most importantly, you have to ask yourself if you have the right tools to exploit these moves. My colleagues and I, we dedicate our days to ensuring that you do. So if you want further information about this research or any of our services, please feel free to reach out to us. If you want to better understand these transitions and themes, you can reference What's Moving Markets, or you can reach out to me directly. Thank you so much for your time. And with that, I'll hand over to Andrew. Have a great day and stay safe.
Thank you very much, Ahan, and very interesting indeed, especially given the current circumstances and current trading climate, which is unprecedented and very unique. So do feel free to send us your questions and so forth, and I'd be very happily answer them now live. And do stay with us, because at the end of this particular conference, you'll be offered a specifically special offer from FXDD, which is unique to people who join us for this particular seminar today. So basically from now on, what we're going to do is we're going to have something which actually is pretty related to thought leadership, which is indeed the remit of Amgad Attia, who is a very experienced FX industry executive. Basically, his position at FXDD being very senior, and actually is going to share some thought leadership before we head towards a very interactive and very lively panel with some of the executives of the company. So over to you, Amgad.
Hi, how you guys doing? First of all, thank you, Andrew, for your invite. I would like to thank everybody who attended this webinar. As Andrew have explained, I'm the Vice President of Sales for FXDD. I've been with the company for over 13, 14 years now, and I represented the company across the globe, in Europe and the Middle East primarily, where I do seminars, webinars, and also public speaking and TV presentation. We are FXDD, are happy to partner with FinanceFeeds to organize this webinar, and hopefully this will be one of many to come in the near future. We would like to thank everybody for being with us. FXDD has been in business for quite some time, for over close to 20 years. We've been one of the leaders in the industry, started in the US. Now we have our offices in Europe. We have offices in Mauritius. We provide our services to retail, institutional clients. We provide all different type of accounts, spreads, white labels, all what you need in terms of an FX broker. We can provide. FXD also has been one of the brokers with the longest longevity in the industry, and actually the management team has been with the company for at least 10 to 15 years for each one of us, which is an indication of how stable of a company this is in the industry that we're in, characterizing by changes all the time. It's good to find a brokerage that has stability in terms of management, in terms of policies, in terms of strategic development. And we've always maintained this discipline. We've always pride ourselves in our personal service that we provide for our clients. We treat our clients fairly. We provide the best execution that we can, and we continue to innovate. We put a lot of focus on our technology. We own our own bridge technology that connects clients to MetaTrader and other platforms. We ensure all the time that we are always attentive, always there for our clients, especially at this time. You know, this is one of the reasons why we are where we are, that we stayed in the industry, we stayed relevant, we stayed present, that we continue to innovate, we continue to be there for our clients. And we're actually happy to be part of this presentation. And as Andrew explained, that towards the end, we will have another special offer. So please stay tuned, stay with us, and we will talk about this in a little while. Thank you, Andrew.
A great pleasure, Amgad, and that's very interesting to our audience to actually explain the history of FXDD, being a company that dates back well into the early stages of the retail FX industry, as one of the actual pioneers in New York. So actually now as a global enterprise around the world, it's certainly a company that we would say is one of the long-standing stalwarts of the industry. So thank you very much, Amgad. And now what we're going to do now is myself and Tom O'Reilly and Lynn Mackey, who Tom O'Reilly has been not only is a very good personal friend of mine, but also has been in the industry for 42 years. So actually one of the longest standing, dating back to the days of voice brokerage in New York, and actually has actually witnessed the electronification of the entire markets, not just the retail sector, but the entire global financial markets. Tom has seen it go from the manual, the days of when you would go to the stock exchange with paper in your briefcase and actually have an open outcry pit and some voice brokerage, and then some telephone sales during the course of the 1980s, and then the electronification of the entire markets, and now is at the senior level. Has seen many brokerage come up from scratch, and is a leader at FXDD. So that's actually of great interest. Now, Lynn has been with FXDD for many, many years, and actually understands the whole way of marketing and how customers interact with the company, which is vital. Sometimes it's overlooked in a way that marketing and actually looking at what customers need is a vital part of the interaction between retail traders and brokerages, because it's such an online industry. Everybody needs to know their customer. So what we're going to talk about in a very animated way is what to look for when you're looking for a good quality brokerage, and how to actually assess the relationship between yourselves and the broker. So let's enter into a good discussion about that. Tom.
Everybody, can you hear me okay?
Yeah.
Okay. Kenny and Ehan and Ilan, great presentations, very, very instructive, very informative, very nice. And I just want to make a special shout out to Andrew. his website, FinanceFeeds, is the go-to site for the industry, in my opinion. Andrew is, if they elect a commissioner of FX, you should be the guy, because
Thank you very much. That's very kind.
very knowledgeable, very passionate about it, and we appreciate you helping us organize this webinar, Andrew. Thanks very much.
It's a great pleasure. It's a great pleasure, Tom. And I think it's really important that we are unique in actually interacting with our actual traders. And I think that's really a good thing. So, you know, you're the expert, really, if anyone is an expert. So how do you look for, if you're a retail trader today, how would you look for a good broker? You know, out of the 1,231 retail brokers that exist, how would you look for a good one?
That's true. Pick it out of a hat? I don't know. No, I think the thing, I think got touched upon it. You know, for us, the number one thing I always come back to, because I've been here from the beginning, is the longevity. As you know, this is a very competitive industry. We've seen a lot of companies come and go. We've seen companies that have grown astronomically, you know, via affiliate marketing, digital marketing.
Yes, yes, many have, yes.
Yeah, has grown very much. We, I would classify ourselves as one of the more conservative companies that are out there. We know what we want to offer our clients. I mean, it's a very homogenous business, right? I mean, everybody talks about spreads. They're pretty homogenous. Everybody talks about the dealing platforms, which pretty much vis-a-vis is MetaTrader these days. Talk about the number of products. Everybody's got 80 plus trading products. Everybody's got some education. So across the board, everybody kind of has the same offering. I think we differentiate ourselves really by the people that are here. And as you touched upon, the people here in this right here have been with the company a long time. A lot of them from the very beginning days. Our management has been strong and steady right throughout. We're not the biggest company out there. We're not flashy. You're not going to see our name all over the place. But I think we excel at what we do. We're very customer centric, and I know that's everybody says that, but we are extremely customer centric in that we're very sensitive to the needs of the clients, and they change all the time. You know, you get calls all the time about, well, you know, whatever the flavor of the day, currency is going crazy. Our desk, Kenny and Nehan, and they try to mitigate, flatten out those little bumps in the road. So I think we do a good job. I know we do a good job, and we're very much thankful to everybody who signed on today. And in particular to you, Andrew. Great job, as always.
Well, you're absolutely right about the changing dynamic. I find that the development cycle especially in the electronic retail trading industry is about, because of the way everything connects to markets these days, there's no physical infrastructure. It's all very much API and hosted and so forth. The development cycle can be as low as 3 months, and so then something can happen, everything changes. So in terms of both Lynn and Tom, both you would know this for sure. What would you give advice in terms of how a trader, how it's a two-way street, how traders can empower themselves and how a broker can actually work with that trader to empower them and make it a two-way relationship, because it is a relationship. Even though it's an electronic business, it's a relationship business at the same time.
Exactly. If I could, I mean, you touched on the going back to the voice broker days, and at the end of the day, this business is really gets down to personal relationships. It has to be interpersonal. Everything these days, you know, everybody's walking around with their phones, and you can do everything on your phone. You can close trades, you can open accounts, you can do deposits, withdrawals in a flash. But at some point, it does all come down to personal relationships. This business in particular. I'm going to give you a quick New York minute here about how we developed to where we are, if you will. When I started, you ready for this? Back in 1977, there were hundreds of banks. Kenny, you would know about this. There were hundreds of banks. They all had trading desks. Andrew, surely you know the tales about the London dealers and brokers back in the day. Everybody was
absolutely.
Oh yeah, they were 20 years old, 30 years old,
They
and
were very young. They were very young, and they were really did very well very quickly. A lot of them.
they did indeed, and they weren't. You know, it's not that they had Harvard educations or anything even remotely like that.
That's
They were
right.
just, they were, you know, street smart kids, and by the time they were 40, they were burned out. And but somewhere around the mid 90s, I'd say when Reuters and EBS came into play, it ended very quickly. The whole business of voice broken and writing trades down on a scrap pad and things like that, and it went electronic. And at that time, also, there were a couple brokers in the industry. I believe Money Garden was an early one. FXCM came about. FX Solutions, FXDD, and then you had the influx of hundreds and hundreds of MetaTrader brokers that can go out and buy an MT4 server and, you know, be up and running in a week. So getting back to what you look for, I think, you know, what we offer is that stability, that personal relationship. We really believe in that. You know, is it going to make us number one? No, but you're going to get a very good service from us. And I'm, you know, I relate it back again, personal relationships. It was the same in voice spoken. There's certainly a measure of that in the digital that we're in now.
There is indeed, absolutely. And I think that the voice, what's happened really with the onset of technology is that the ability to concentrate. I mean, I'm a technologist rather than a trader, really. I was working at the banks as a systems engineer for most of my 29-year career in this industry. And that's really pretty much how I got to know everybody. But basically, if you're looking at the way, in my opinion, the electronification of everything has caused people to be able to concentrate better because it's silent and there's much less noise, and you can actually, with the right charting and analytics and with the right support from a broker. And Tom, you mentioned differentiation. It's really important that, and you know, if you have to those who are with us now, if you're looking to diversify your product range, it's well worth talking to FXDD because they are very well connected to the multi-asset aspect of the industry and so forth as well. So there are ways of trading multi-asset instruments. We're talking tens of thousands of instruments, not just spot forex, which is really a good time at the moment to look at diversifying the way of looking at empowering yourselves as a trader.
Yes, yeah, we're very excited about that. I'd like everybody to stay tuned on that. We're very excited. We've been working behind the scenes for 2-3 years now, and we will have a multi-asset product, and it will be stocks and futures and FX and whatever assets we add on. But I think that's the direction the business is going in anyway. FX is a little bit long in the tooth. It's still a very vibrant and growing industry. But what are we looking at, 20, 30 years now? And the average life cycle of a business is probably 10 years or whatever.
Yeah,
so
something like that.
Take away from FX, it's always going to be there. But I think trade is, and especially on the back of this little vacation we're all taking, come to realize that I think day trading is one of the biggest Google searches currently. You know, everybody wants to know how to day trade. So I think the ability to trade across margin, across different asset classes is going to be huge. So yeah, that's another direction that we're looking at for sure.
Absolutely. And I think what I'm going to do now actually is to involve Amgad in this, because I think you can all three of you can talk about the way we're talking about how to interact with the traders and how a brokerage can actually be part of your lifestyle, because it's often overlooked that traders use a broker. The broker to many people is just the actual MT4 on the screen. This is a unique experience because you're actually getting in front of the executives who are running a broker. So these are the people who you are facing when you're actually running the business that you're facing, when you're actually placing your trades, which is really important because I think it's not just the institutional world or the interbank world that should be relationship based. It's everywhere. So we're going to involve Amgad here as well, so that all three of you can actually explain the special offer that is unique to the people who are actually who are joining us for this particular conference today. So I think it's really worth looking at that because we think that it's worth being treated as special customers, really, because it's a unique experience.
So as you have indicated, Andrew, you know, we've been around for quite some time. We always listen to our clients. We always interact. As you have said, business has changed dramatically during the last few years. Many companies came into the arena. Some companies left. But we've always been there. We always try to listen. We always try to present our client with the product that they're looking for. We're always trying to interact with them. Primarily, for many years, I've always made sure that we interact on a daily basis. Now the market has changed, not just emails and webinars and seminars, but there are social media, Facebook, Twitter, WhatsApp groups, all these interaction with the clients now. It's no longer just simple emails and simple website. A lot of customers, know about brokers through WhatsApp groups, through Telegram groups. There are so many different ways that now we can reach out to clients, that they can always interact with you. And we always listen. We always try to maintain the connection, that we have with them all the time. We're trying to innovate. We're trying to present new products. As Lynn, that's involved with me in management with FXD, we've always tried to listen to clients. We always try to see what they want, what they're looking for, and always present to them. And then maybe I'll let Lynn to, get in on this as well.
Well, thanks, Amjad. It's going back to actually what Tom said. I mean, from the beginning of time, we've always made it our core focus to make our business customer-centric. We always look ways to bring the best trading environment to our customers. So by that, we always try to understand the needs of the customer by putting them at the center of everything that we do. It's always an ongoing process, obviously, because there's financial and regulatory environment is ever changing within this space. So by listening and monitoring to our customers' interactions, not only with us, but their responses and reactions to what's going on in the industry, we try to build our business around them, starting from product line to business unit and geographically. And so, we offer many different asset classes. We provide competitive spreads, at least we try to. And we try to practice best execution. There's various educational tools that we offer, various payment gateways to make it customers easy to make deposits and withdrawals. And we always have a responsive and intuitive customer service team. And on top of that, we've expanded and continue to expand our services in various parts of the world by establishing offices throughout the EU, Middle East, Southeast Asia. And I don't think we would have survived almost 20 years in this industry without doing this.
Yeah, absolutely right, Lynn. I mean, as Lynn have said, we've always tried to listen, always see what is new. Our offices across the world has provided, first-hand customer service to our clients. We're always trying to be innovative in terms of, providing clients with payment resources. Unfortunately, the regulatory environment has become tighter and tighter everywhere. So we always try to provide our clients with all available options for them, whether it was in Europe or in the Middle East or in Asia, and try to provide them with the opportunity and then give them the choice. What would they like to do? How do you like to do it? But at least we provide them with the choice to trade with a reputable broker, and providing them with the condition that they look for and the condition that they want to as well.
Yes, indeed. So I absolutely agree with that. And I think we really are in a time at the moment where it is critical to look for the right broker. We've seen it all before. If you're an experienced trader, no doubt you'll have received very similar contacts from very similar, and many of them are small white labels. And it's really worth looking at the longevity of a brokerage and what they can actually offer you. So I'd like to conclude my part of of hosting this particular unique event by asking Amjad to explain what exactly can be offered to traders that are with us today.
So as a special time promotion offer, let me allow to see if I can share my screen. Okay. So as I said, FXD has plenty to offer to our clients. So as a special limited time offer, we would like to give 1 month commission-free trading on our ECN Prime tiers. This is the tightest spread that we offer. It's basically a spread starts with the 0.01, really competitive, really fast execution. we would like to offer 1 month free trading. Also, if you decide to trade on our standard tier, we can also offer you deposit bonus, which is also available for a limited time. FXZD has multiple jurisdictions. We have FXZD Global, we have FXZD Mauritius. These are our 2 entities that can offer various leverage capabilities to a client depending on their needs. So we will be emailing you all the links and all the information about how to take advantage of this offer. And we would love to interact with our clients. We will provide also all our contact information in this upcoming email. So stay tuned, and hopefully you will have a wonderful trading experience with FXD in the near future.
Super. Thank you very much indeed, Amgad. And I'd like to thank you all for joining us today. It is something which we will certainly like to keep in touch with you all, and we will be doing so over a long period of time. And welcome, we'd be very welcome to address me personally at FinanceFeeds as an independent, lifelong, my whole career has been in this industry, 29 years, so I'm pretty much impartial and know everybody. So you're very welcome to approach me, and I will help you with your FXDD journey. And I'd like to thank, of course, Kenny, Ahan, Tom, Lynn, and Amgad for joining us today and for presenting to traders in this unique event. So I wish you all trading success, and I wish you a very good union and relationship with FXDD. All the very best. Good night.